Should you invest in Facebook? That's what we're going to review in this video, and I'm going to give you some potential other options as well if you're looking for some pure play advertising stocks, and one of them is killing it today in the markets. Let's see if it continues and see what we think about ads. Just remember that I've got to give you an ad, and that is to remind you that this channel is brought to you only by the programs I'm building your wealth linked down below. There are no other sponsors. It's just those linked down below. We've got a final coupon code expiring tomorrow, February 3rd at 11:59 p.m. Would love to see you there. Email us if you have questions at kevin@mekevin.com. Thanks so much. Now we're going to talk about Meta. Advertising, Snapchat, Pinterest, Trade Desk, and could advertising as well as Google potentially be a massive sector that is missing from your portfolio? Let's do some fundamental analysis and understand a little bit of what's going on in the advertising sector. Look, the first thing that we've got to start with is we've got to talk about Facebook, because obviously their earnings were such that folks got very optimistic with a higher revenue beat than expected. Mark Zuckerberg talks about making the company more efficient. There was a lot of talk in the earnings call about being tired of having managers managing managers. Facebook laid off about 11,000 people, and the idea for Facebook is let's try to make the company a little bit flatter, less sort of hierarchical, which is very expensive because every payroll is expensive. If you are an employee, whatever your salary is, remember that the company probably has to pay about 50% more just to keep you around. So if you make $100K, it probably costs the company $150,000. HR, payroll taxes, workers' comp, supplies, mistakes, days off, paid days off, vacation, sick time, you name it. There are a lot of costs that come along with that. But that's okay. But it makes sense if you can cut out some middle-level management and keep the company more efficient. There's a great opportunity to reduce your cash burn, especially since Meta continues to expect to spend a lot of money on Reality Labs, which is really their money-losing division for the metaverse. And the reason Facebook is really doubling down on the idea of the metaverse is because they believe the metaverse, in my opinion, is the next frontier for social media advertising, and they want to make sure they get the grip on the metaverse, so that way when people start actually spending more time in the metaverse, maybe the time they spend now on YouTube, they spend in the metaverse, Facebook could be the one that has a dominant advertising platform. So this year, at least, they're calling 2023 the year of efficiency, simplifying their organizational structure, and really trying to get back to a return to growth. They're increasing their share buybacks, they're lowering their expenses, and really, while digital advertising demand and pricing is still weak, they're starting to see some green shoots, along with an improvement in online e-commerce. Now, that was actually surprising to me. So you're seeing e-commerce see a little bit of a pop in advertising, and you're seeing travel and health spending substantially up. The sectors that are down in advertising are financial services and technology, with average price paid per ad down about 22%. However, they did allude to more growth in the potential advertising sector for short-form content, such as Facebook and Instagram Reels, which YouTube just yesterday turned on monetization for short-form Reels, YouTube Shorts, basically, 60-second or less content. They just turned on monetization for that. So we'll see what that ends up doing to the advertising sector. But there's a lot of focus on Facebook, Snapchat, Trade Desk, and Google for advertising. Google does end up reporting today. Pinterest is another one that's moving on this. They just announced they're expecting to cut 150 jobs. You've had similar cuts at Google. Google just had 5 executives from the DoubleClick ad business, which some say holds about 90% market share in sort of the brokering sector for brokering website ads. 5 executives just apparently lost their jobs there, along with potentially hundreds of other individuals working there. Google has about a 25% market share of all digital advertising, and then in the other 75%, you've got companies advertising like, obviously, Facebook. Then you've got YouTube's obviously part of Google, but then you've got a Trade Desk, which is your connected TV advertiser, and so on. Now, what's fascinating about the advertising sector is you've kind of got these hit and misses. You've got Facebook seemingly potentially excited, at least their stock's excited, seeing some green shoots in advertising again, but you're still getting a hit from Reality Labs and cash expenses to where they're trying to refine their business to make it more effective. Unfortunately, you had Snapchat that reported, and they missed bigly. And that was potentially because you've got 90% of Snap's user base being under 25 years old, leading to potentially less, dare I say, advertising revenue than some of the other platforms. After all, Snap generates more impressions per dollar than Google or Meta, but that's potentially because the users are just a lower value target. So advertisers also tend to have limited data using Snapchat on how their ad is doing, and this is leading a lot of folks to focus on different platforms. It kind of brings me to wanting to look at two things. One, I want to look at the fundamentals for Facebook, and number two, I want to understand Trade Desk and their UID2 platform a little bit more. First though, let's look at Meta's fundamentals for a moment. So here's Meta fundamentally, and we'll go ahead and look at some of these numbers together. So Facebook's revenue declined for the third quarter in a row, year over year. So you're really in a revenue recession at Facebook, right? Their revenue is down to $32.1 billion versus $33.6 at the same time last year. That's about a 4.5% decline in revenue. At the same time as their revenue is declining, their costs are going up substantially. While their revenue declined 4%, their costs of goods sold, which actually doesn't include research and development, increased 31%. So even though the stock is rallying, you do have some problems. Revenue declining 4% and costs of goods sold up 31%. R&D also exploded. $9.7 billion of R&D expense compared to about $7 billion of R&D expense last year puts you at about a 39 percentage point increase in research and development. Their marketing and sales and G&A stayed roughly flat to slightly negative. And really what you had was a cost structure that just became a bit more, well, costly. So their net income fell. Their net income sitting at about $4.6 billion, down from $10 billion last year. So you've got about half as much income coming into Facebook as you did last year. And if we go to a cash flow statement for the company, we're not terribly worried about the company's assets and their balance sheet. The company's well capitalized. But if we look at the cash flow statement, we can see, do they actually have cash flow? And if you take their net income and you look at their operating cash, they do. They've got operating cash of about $14.5 billion in net cash provided by operating activities. Hold on, let me just make sure quickly that we've got this aligned properly here. We've got net income of 4.6. We've got depreciation, share-based comp, accounts receivable, accounts payable. We've got other liabilities. We've got net cash. Okay, yeah, exactly. Okay, then here we have purchases of property and equipment, $9 billion. This gives you a free cash flow estimate. Free cash flow would be the difference between cash flow from operating and cash flow or cash expense for investments. So if we look at 14.5 minus 9, you're sitting at about $5.5 billion of free cash flow. It's not bad. So they're still making substantial amounts of money. And part of this is because they're adding back in about $2.3 billion in depreciation. They're adding back in $3 billion of share-based compensation. So you really have a company that's not short for cash. They've got plenty of cash. $5.5 billion of cash in just the 3 months ending 2022. That's not bad. It's actually very impressive. If you look at the free cash flow for 2022, this is a company that's killing it with cash. For the entire year of 2022, you're sitting at free cash flow of about $15 billion. So plenty of cash. The question that you have to ask yourself is if you want to make or if you want to make a Meta investment, if you're asking yourself, should I invest in Meta, is you've got to ask yourself, do you believe in the potential future of Reality Labs? Because that's obviously where a lot of money is going right now. Twice as much of their free cash flow is basically going into research and development, and that's expected to continue. So you have to believe that ultimately Reality Labs and virtual reality is, as they say, the next evolution in social technology. And if you don't believe in that, probably don't want to invest in Facebook. Now keep in mind, there are also other players in this space. Take a look at Apple's upcoming mixed reality virtual headset. This is a Bloomberg piece breaking down exactly everything you want to know about it. I'll give you a quick picture of roughly a rendering of what it might look like. You can see that on screen here. Looks pretty cool. Some people say it's a little bit uncomfortable though, based on some of the people in the beta for it. Well, probably more like an alpha for it. But anyway, Apple's long-anticipated mixed reality headset is an attempt to recreate a 3D version of the iPhone operating system. So think about basically apps and icons on sort of a 3D augmented reality space in front of you, and somehow being able to control those buttons with gestures. So there won't actually be a hand control device. There'll actually be cameras that look down at your hands to try to understand what you're gesturing, so you can kind of move around or maybe touch a keyboard or something. That'll be quite interesting. Now, the expectation is this will cost about $1,000, and it's likely to be named Reality Pro, which I feel like is a little bit of a jab there at Metaverse's expenses on Reality Labs. Then in the future, they expect to potentially come out with $1,000 product, like a lower cost product, so starting with the premium tier and coming down. Hand and eye tracking capabilities, ability to connect to external or become an external display for a connected Mac. Basically, you'd zoom and pinch with your fingers and your thumb. There'll also be a little wheel, which I think is kind of cool. At least that's the rumor, that you'll be able to kind of go from virtual reality to augmented reality. So that way you can see the world in front of you with sort of layers of apps and stuff. I think it'd be neat if I were ever on a run to be able to wear something like this, if they got light enough and the battery packs got light enough to be able to kind of see the world, but then have, news up or something. I don't know. It's maybe that's a bad thing, but that's kind of what I envisioned for this. But I think Apple is doing this with a separate battery pack that you would carry separately, and it's not actually on the head device, unlike the Facebook version, which is on the head device. A lot of people talking about this as potentially being useful for health tracking, video games. I think maybe like one-on-one FaceTimes will be useful with couples for this, or maybe if you're in the future in a self-driving car or you're on a treadmill. This could be kind of useful. M2 will be made with Taiwan Semiconductor's enhanced 5-nanometer technology and its neural processing units containing 20 billion transistors. This will be a 25% increase from the M1. Some testers have complained that it can be a bit cumbersome. Headset battery pack lasts for about 2 hours. And people will be able to try it out in the actual Apple Store. Now, the reason I bring that up with Meta here is obviously because there's competition in that Reality Labs space, and Apple's the big boy coming in. We could actually look at segment information here at Facebook and see that Reality Labs, let's see here, Reality Labs. This is quite interesting how this is aligned. There we go. These align like this. And then we have family of apps here, Reality Labs. Reality Labs showing, I don't know why this is so misaligned here. It's so difficult to understand. Reality Labs, this is segment info of revenue. There we go. Okay, Reality Labs created $727 million of revenue, and Reality Labs cost about $4.2 billion. Almost $1 billion more than what the company or what the loss was last year. So you get about $4.2 billion going into Reality Labs in losses. And that is just in the last 3 months of 2022, which means if you look at that on an annualized basis, they're spending about $17 billion a year in losses on the metaverse. So again, even though they're buying back shares, the numbers aren't as bad as expected. In the long term, you got to ask yourself, how much do you believe in the potential for a company that's shrinking revenue to be able to turn around and start creating revenues again? And that's ultimately a question you have to ask yourself as an investor. Now, one of the things you can do to help you along with that is we could look at Wall Street consensus estimates. And if we jump over to Facebook for Wall Street consensus estimates, yeah, let's see here. We can find out that the projected earnings per share for Facebook in 2023 is $11.50 $11.4, and that could grow by about 20% for 2024 and 2025. But things get really blurry after 2024 and 2025, where Wall Street actually thinks that earnings are going to go negative again by 2026 and 2027. So in other words, unless you start producing revenue from Reality Labs by 2026, your earnings are probably going to start declining again, which would make your cost per growth very, very expensive at Facebook. But consider that company's multiples right now. Right now, Facebook stock in the pre-market is trading for about $1.85. Divide that by about 11.4, and you're trading for about a 16 times multiple. If you think that the company's going to grow at 16% in the foreseeable future, you're really only paying about 1 times for the growth. PEG ratio, right? Dividing 16 times earnings by 16% growth, you're at about a 1x. However, if Facebook doesn't end up pulling it off with Reality Labs and their growth ends up only sitting around a measly, let's say 2 or 3% on average over the next few years, or let's just go with an even 5 to make math easy, well then you're probably paying closer to 3x on a PEG-based ratio, and that actually makes Facebook look very expensive. So an investment into Facebook right now, if you're making a longer term investment, is solely based on the growth you expect from Reality Labs. Personally, you can make a similar sort of analysis. I think you can make a similar sort of analysis on Intel. Now, Intel is a company that's going through very much a similar transition as Facebook, except rather than betting on the metaverse, Intel is betting on 3 and 4 nanometer chips, which are advanced chips to be developed in new fabs that they're building in Ohio and expecting to come online by 2025. Right now, they use a lot of they actually use a lot of Taiwan Semiconductors for their building. And so, if you're heavy into Taiwan Semiconductors and you're looking for potentially a value play on a transformation, maybe Intel is that opportunity where you're actually hedging against TSMC because now you have an American manufacturer, the largest American manufacturer, and you're betting on sort of a turnaround. Personally, I would rather make a bet on the Intel turnaround, thanks to the CHIPS Act and the tailwinds that has, versus a bet on the metaverse, because I don't actually think we're close to the metaverse yet. I think the metaverse is something that would be Ready Player One-esque maybe in the 2030s plus, but I'm not convinced that Facebook will be the one to actually get us there. And so I'd rather wait to see what actually happens before I make the bet. And so when it comes to advertising, I actually am much more interested in a company like Trade Desk. Now, don't get me wrong, Trade Desk has not reported earnings yet, and this is going to be big foot and mouth if Trade Desk ends up missing. But I will tell you this. Oh my God, Trade Desk is up 8% in the pre-market right now. I have no idea why, possibly just off the back of Facebook. I just realized that. Trade Desk is up at $56. Trade Desk is one of it's actually my largest advertising holding in my portfolio. Now, I want to explain a little bit about UID2 because there's a lot of confusion about UID2. So UID2 is something you have to know when it comes to advertising because it's basically a new form of a cookie. It's an opt-in cookie where basically you opt in to be tracked for your phone number, your email to be tracked. And initially you might think to yourself, why would you want to opt into that? Well, you're right. Most people won't. In fact, only about 10% of people are expected to opt in to UID2 style tracking or really any kind of tracking. However, all UID2 really needs is about 10% of people to opt in, and then they can model the 10% of people who opt in, model their behavior and their characteristics against the characteristics of other people who behave in a similar way. And this is why UID2 potentially raises your CPM metrics on advertising by as much as 116% compared to companies using third-party cookies. That's really good. On top of that, some companies estimate that their reach has increased as much as 40% and potentially led to a 1,000% increase in their actual return on spend. Now, this is incredible, and some of this information is, brought to us by Publift, which in the advertising space could be a little bit on the biased side. But UID2 is worth noting It is an open source tech, and it's basically your new version of cookies. And Trade Desk is one of the companies that's in connected TV advertising, where through UID2 and with connected TV advertising, Trade Desk expects to be able to blow up their advertising revenue. Now, no guarantees, but it's basically the new frontier for advertising, where people are saying, look, why do we want to be on Facebook when you have problems with being able to track advertising success, when you could move over to the new technology, which is UID2. Again, an open source framework, and the goal of it is actually to protect user privacy. And now that's interesting, because this is kind of the chart of how it works. I'm not going to go super detailed into this, but basically the user visits a website, the publisher explains, hey, you know, do you want to opt in, basically? And it gives you the option. 10% of users, let's say, opt in. Now that creates a token for that user, and only the non-public information is transferred to basically the auction websites for advertising. And you get this exchange of information for being able to basically track people on the internet. And again, if you can model around the 10% of people who've opted in, then you can continue to sell more ads more effectively. And I think the best thing to do is just look at the success that some companies are having, and some companies are having great success. So for example, if you look at Coco Village, they're the ones talking about a massive increase in return on ad spend and a substantial boost in reach. On top of that, you're seeing Trade Desk very optimistically argue that this recession is an opportunity for them to actually gain more market share and get people realizing, look, in a recession, companies are going to have to be more careful with how they spend money. So why would you spend money on regular TV advertising when you could use connected TV advertising, or you could get the advantages of UID2 through some of the services that a company like Trade Desk provides? Why not go to a company like Trade Desk and have a substantially more efficient advertising platform than potentially waste your money on Facebook? And I'm not trying to bag on Facebook. Obviously, I'm biased here. I invest in Trade Desk, and I don't invest in Facebook because I don't believe in Reality Labs, and I do believe in UID2. But it's an interesting thing to think about. Again, this will all be foot and mouth if they miss earnings here when earnings come up. But it's fascinating because you are in this sort of brave new world of advertising where Snapchat's having trouble figuring it out. Their user base is very young. Pinterest, somewhat a bit of a dying platform. Google is getting sued by the Department of Justice for potentially being a monopoly on sell-side advertising for brokering website ads. Then you have Facebook, which is throwing all their money away on Reality Labs. And so when you start looking at the advertisers, who do you really have left that's like a pure play advertiser? Well, in my opinion, one of the few pure play advertisers is Trade Desk. On the other hand, you have Apple. But Apple is great on one hand because of Apple ads, obviously a little bit biased with Apple because Apple can kind of make it harder for everybody else to advertise while at the same time pitching their own ad business. But Apple's not a pure play ad business, right? Apple's a products and services business. And then there's a little bit of advertising in there. So from a pure play advertising point of view, I think Trade Desk is probably the best option that exists. # no guarantees, obviously. And then after that, you're probably maybe considering companies like Disney or Netflix for their exposure to TV advertising. But then again, I'm not entirely convinced on their ability to convert ads to profitability through Disney Plus or Netflix. And instead, I'd rather be investing again in the pickaxe instead of the company itself in that case. And who's the pickaxe for Disney's connected TV? Trade Desk. So kind of all points back to Trade Desk. Now again, no guarantees, but I'm very, very excited about Trade Desk in the advertising space. And I think it's a good place to have exposure, especially since their financials pretty solid. Again, no guarantees. Fourth quarter is going to be great, but you've got revenue that increased in the third quarter year over year 30%. Now what we can do is we can kind of compare that to what it was in the prior 9 months to get a little bit of a trend. I don't have that written down here, so let's do that really quick. Let's divide by 808. That puts us at about 35%. So you've got a slight slowdown that's already been realized, but in other words, you had 35% growth in the first 9 months of the year, down to about 30% growth, still growth. But what I love about this company is the margins that they have And we've got to, unfortunately, and that makes this potentially a little bit harder one to analyze, is the pink that I've highlighted here shows a single one-time large boost in stock-based comp for the CEO. Little bit of a problem here because it makes it look like Trade Desk almost lost money. They didn't. They made about 16 mil, but it's a substantial plummet from the 2021 60 mil in rev, or net income rather. If in the fourth quarter growth stays stable at above 25% and we get that stock-based comp out, we should see some pretty good margins at the company, which is exciting to me, especially since their platform operations are basically their margin, right? That's for gross margin. So if we look at $70 million in expenses out of $394 million in revenue, you're only talking about 17% in expenses, which means you've got about an 82% gross profit margin. OpEx grew at about 44%, so we want, in terms of sales and marketing, so we want to keep an eye on potentially sales and marketing growing faster than rev. So this is not a risk-free company, but it's definitely a company that I think has upside from here. And again, no guarantees, but it's one I'm excited about. So these are some of the things that fundamentally I'm watching, and curious to know your thoughts. So leave me some comments. Now, question here, what about Google? Google, I think, again, great exposure for what you've got to YouTube. Big fan of that. However, YouTube revenue actually suffered a decline in the last Google earnings report. Now, we're going to get Google earnings today, so hopefully it goes back. That's what I'm going to be looking for in the Google earnings, is I'm going to be looking for a return to YouTube advertising growth. Take a look at this. This on screen right here is Google's ad network income, and you could actually see that in 2021 you got $7.2 million for YouTube ads, but only $7 billion in 2022, which is a decline of about 1.85%. Google search still grew, but then again, Google search is where they're suffering from the Department of Justice inquiry into their models, right? So, and you've got Google Cloud growth slowing. So these are some things to pay attention to for Google. Again, not a pure play advertising play. Again, watching. I think the next earnings calls, especially the Google one today, will be very insightful, and those will be things that I'm paying attention to. But some of my thoughts there on the advertising sector. Hopefully that on advertising was insightful or interesting to you.